my dear students, in this lecture we will be talking about the financial statements. In the last video we have discussed that why there is a need of preparing the financial statements. So we have studied that the financial statements are the reports which are prepared by the directors and which shows the financial performance and financial position of the company, and these reports are prepared for the shareholders. So financial statements are the reports prepared by management, or you can say prepared by directors. And these reports are prepared for the shareholders. And who are the shareholders? These are the owners of the company. And they will be looking at these financial statements to take the information how well the company is performing. So I can ask you a question that why shareholders need the financial statements? So the simple answer to this question is the decision making. Like say for example, you have investment in the company. Now you need to know how well the company is performing. Because if the company is performing well, you will be spending more in that company. You will be investing more in that company so that you can make more profits out of it. But what if you have made the investments and you are not getting your desired results? Your expectations are not being met, then what you're going to do is you will be withdrawing your funds from that company and you will be spending your investment, you will be making your investment in some other company. So that means the simple answer that why the shareholders need the financial statements is because they need to take decisions. For decision making, they need to know regarding the financial performance and position of the company. Because if they are not satisfied, if their expectations are not met, then they will be withdrawing their funds and they will be investing somewhere else. So financial performance and position. But there is one more thing, that the financial statements are required for the potential investors as well. Now, potential investors mean those people who want to invest within the company. They have not yet invested, but they want to invest within the company. So they will be needing the reports of the company as well. It makes sense. Like if you go to if you go to any person and say, I need you to give me some investments for investing into a business, and then I'll be giving you the returns. So you're gonna say, okay, I'm giving you investment, but first of all, you need to tell me how how well your company is being earning from the in the previous year of in the previous years. He will be looking for some results, actual results, which have been earned by the company in order to make sure that they are investing in the right company. So the potential investors even need the investment, even need the financial statements to invest within the company. So this is the important thing. Now, what are the financial statements? Financial statements are reports prepared by the company's management to present the financial performance and position at point in time. The financial performance and position, that these reports will cover a specific period. Now, whenever you see the financial information, there will be some date on it, that okay, which year or which date these financial statement or these financial belongs. So they are prepared for a particular time period. Now, how many types of financial statements we have? Remember, 5 statements. 5 types of statement usually we have. Okay, what are these? The statement of financial position. So the statement of financial position talk about the assets, equity, and liabilities. To make it simple, just remember the accounting equation. These 3 contents were over there. Then you have the statement of profit or loss. So that means this statements will be showing the revenue and profitability, or if there are losses, then that will be showing the losses. The statement of changes in equity means it will be showing the capital and all the things which are related to the capital, such as profitability, such as if there are drawings, everything. And then you have the statement of cash flows. This will show the inflows and outflows, cash inflows and outflows. And then there will be the notes to the financial statements. This is also known as the disclosures. Now, obviously, it is too early to describe you what are the notes to the financial statements, but let me give you a basic idea. Whenever you are performing the accounting, there are certain assumptions you will be making. There are certain policies which you will be following. There are certain estimates which you will be making. So all those assumptions, all those policies, all those models will be disclosed in the notes to the financial statements. So whatever assumption the company has taken in order to prepare the financial statements, whatever model they has adopted in order to prepare the financial statement, whatever estimates they have taken, all those assumptions, policies, estimates will be disclosed in the notes to the financial statements. Obviously, it is not possible that you start preparing the notes because it is not in your syllabus preparing the notes. This is just an idea what type of financial statements we do have in the real life. So we have 5 types of financial statements. So statement of financial position, statement of profit or loss and other comprehensive income, statement of changes in equity, statement of cash flows, and notes to the financial statements. So remember this thing that the shareholders need the financial statements for decision making. They need to take certain decisions whether they should invest more in the company, they should withdraw their funds, or the potential investors need to know regarding the company so that they are investing in the right company. What are the elements of the financial statements? We have already discussed assets, liabilities, equity, income, and expenses. We have already discussed this thing in the video in which we discuss assets, liabilities, and all those things. So this is the general format right in front of you of the statement of financial position, and I've already gave you the idea that these are the components which were in the accounting equation. So hopefully you remember that these are the components which you find in the accounting equation. So first of all, you have the assets, and then there will be non-current assets, then there will be current assets, and then you have the total assets. Then you will be having the equity and the liabilities, then the equity, retained earnings, and then you will be having the total equity. Then non-current liabilities, current liabilities, and then you will be having the total equity and liabilities. So remember, in the assets you have non-current assets and current assets. So the sum of these two is known as the total assets. Then you have capital or equity and liabilities. First of all, you will be having the equity, and then you will be having the liabilities. The total is known as total of the equity and liabilities. So just like your accounting equation, the total assets should be equal to the total equity and liabilities. If these are not equal, then that means the financial statements are not prepared correctly. So the sum of the total assets should be equal to the total equity and liabilities. Then you have the statement of profit or loss and other comprehensive income. In this lecture, we are not going into detail of each components. We are just looking at the financial statements. So you have the revenue, and then you have the cost of sales, which is the cost of goods sold. Now, because you are selling the goods, this is the revenue which you are getting from the sale of goods, and this is the cost of those goods. Then you will be getting the gross profit. After that, these are the expenses. These are the expenses. And then you will be getting the operating profit. Once you get the operating profit, there will be the finance cost, and then it will give you profit before tax, then there will be the income tax, and then you have the profit for the year. We'll be discussing these components when we are moving towards the chapter of the final accounts. But right now we are not getting into each component because it is impossible at this time, or you can say it is difficult at this time to make you understand the components and what is the relationship of these components with the profitability. Then you will be having the other comprehensive income, and then you will be having the total income for the year. We'll be putting the values over here, sales revenue, and then we'll be having cost of sales. It will give you the gross profit and all those things. So just looking at the basic format, and the basic format is sales minus cost of sales gives you the gross profit. Then you have expenses, and it gives you the profit for the year, because even the finance cost and the income tax is your expense. This is the important thing you need to understand. The users of the financial statement, who will be using these financial statements. So obviously we have discussed that the first right to have the financial statement is of the investors, the shareholders, and the potential investors who will be investing in the company. Now they need to know how well the company is performing, or the potential investors need to know how good company is to invest, because if they are investing in a bad companies, they will be losing their investments. Similarly, employees and trade union representatives, they need to know that they are in the company where their employment is secured. For example, if I'm going to work in a company which is going to shut down in the next month, then my employment is not secured. So a company having a reasonable financial statements, a reasonable financial performance, or a good financial performance and position, I'll be happy to work over there because my job will be secured. Now, lenders who are giving the loans to the company, they need to know that they are giving loans to the company which can pay back. If they are giving loans to the company who cannot pay back, they will be losing their money. The government need to see whether this company is able to continue because it has provided employment to the people. Also, the government has to collect the taxes based on their income which they have made. The suppliers need to know that they are giving supplies and giving credit to the people who can pay back. The customers need to know that they are getting in the contract with the companies who can have the long-term contracts, who can supply them in the longer run. The public need to know that whether this company, which is a corporate citizen as well, will be doing some welfare for the society because they are earning from the society. So these are the things, these are the users of the financial statements, and everyone is having their own objective that why they will be looking at the financial statements. So in this lecture, we just need to have a look how many types of financial statements are, and in the statement of financial position, you see the assets, liabilities, and equity. In the statement of profit or loss, you see the revenue and the profitability. In the statement of changes in equity, you see the capital and the changes in the capital. In the statement of cash flows, you see the cash inflows and cash outflows. In the notes to the financial statements, you see the disclosures, which are actually the policies and assumptions and have all those things which are being used in preparing the financial statements. So this is the important thing that you need to understand regarding the financial statements.